This conference will now be recorded.
Hello and welcome to the SIA Wealth Management Advisor Update for July of 2025. My name is Colin Cieszynski, Portfolio Manager. In this month's update, we'll do a global markets update and overview. We'll look at some recent changes in the economy and investor sentiment, and then we'll wrap with our portfolio updates and a look at some of our recent performance. First of all, looking at the economic overview, things have been volatile throughout the year in both directions. We have had markets hit new all-time highs of late, but at the same time, we've come into July where we had this rally start in April when Trump did the 90-day delay to tariffs, but now we've reached that point where the 90 days are up, and now they've ramped up their tariff threats again in July with a deadline of August the 1st for new tariffs. Now, with that, we have started to see some deals start to get done. There's a deal with Japan today and Vietnam and Indonesia. But what is interesting about that is that we are seeing these new deals include tariffs. So that's something that some tariffs, not as much as they were threatening, but not zero either. So it's something for us to recognize. And the U.S. now has motivation to do this because in June, they generated a budget surplus based on increased income they got from tariffs. And at the same time, tariffs haven't crashed their economy. So they do seem to have a reason to go forward with it this time. There's still a number of other countries that the U.S. is talking to, including China, Canada, the European Union, and many others, but results are not guaranteed. We'll see what happens. Also, the U.S. has started to launch sector-specific tariffs, beginning with steel, copper, drugs are apparently coming, and maybe others we don't know. So this tariff story could continue for some time yet, but so far so good. Interestingly, the U.S. has a Fed meeting coming up next week, and of course the White House has been pushing for interest rate cuts. They threatened to fire Powell, then they changed their minds, but so some people have been wondering if there's a July interest rate cut. But this to me would seem to be somewhat unlikely, given that 2 days after the Fed meeting you have the tariff deadline. So with all of that going on, we might not see a cut this month, but the Fed is still expecting 2 cuts later this year, which could be September and December potentially. Well, it depends on what happens with tariffs and with the economy. Looking at the equity action call, we remain at 100%, just as we were last month. So that's a very strong action in equity markets relative to non-equity asset classes. So far, equity markets have remained strong, and as I mentioned, indices in a number of countries around the world have been hitting new all-time highs, including as recently as the S&P 500 this week. Over the last month, it's overall been very strong for equity markets around the world. It's been just about everybody is positive, with the exception of Brazil and Argentina. Everybody else has shown strength in the last month. So it's still sentiment seems to still be risk on and still be seeking returns and looking for results from equity markets. Looking at our sector scopes, which is a review of the bullish percent of 31 industry groups, we can see that we're kind of in the center right portion of the majority of groups are in the center right portion. And what that means is overall for the market suggests that it's indicative of a bullish market environment, but not overbought. So at this point in time, it's just indicative of a rising stock market. This is what you'd expect to see. And also what we're seeing is that we're seeing cyclicals at the highest end and financials. So aerospace, manufacturing, electronics and semiconductors, banks, financial services, all doing well and showing strength. On the other side, on the weaker side, we have the defensives, healthcare, food, diversified industries, also resources, chemicals, and energy. Couple of other weaker things that we do know, however, is transports are struggling. So we're keeping an eye on that for the moment. In terms of seasonality, we're a little bit different this year. Usually the year starts off strong. We have some softness May and June, a rebound in July, and then August, September tend to be weak into mid-October, and then strong to finish the year. This year, that all seems to have been pulled forward a bit. We had weakness in the stock market through February, March, and April, and then May and June were much stronger than usual, and now we're into July, and I think as a function of the the fact that we've seen May and June were so strong. July is not as strong as usual. July has been weaker than usual. It is still positive, but not as positive as July often is. And something we've seen, and I'll speak to this a bit more later, is the reaction to earnings reports has not been as strong as you would expect, as one would expect, or as strong as the data would suggest. So looking at the world markets overview here, equity markets continue to climb a wall of worry. Even with all the threats around tariffs, even with all the political uncertainty, even with a war in the Middle East, stock markets keep on climbing. And we've seen new all-time highs for a number of markets of late. Meanwhile, the other thing that was interesting, though, is that we've seen weakness in the U.S. dollar. The U.S. dollar fell more than 10% against a basket of currencies in the first half of the year. That's the worst first half performance since 1973. That's 52 years. That's quite something, really, when we think about it. Just how soft the dollar has been, and that helps to support businesses in the United States. It's important to remember that a falling dollar is equivalent to cutting interest rates. So they may not be getting rate cuts from the Fed, but they are getting support from a lower dollar. Copper, meanwhile, on anticipation that maybe this trade war will blow over a bit and the weakening U.S. dollar, copper has rallied above $5 a pound for its highest level in over 40 years. So it's doing well. Gold is also held up in response to the weaker U.S. dollar. You'd think with confidence improving, Bitcoin soaring, and things like that, that gold would come off, but it hasn't, and that's to me seems to be because it's the natural opposite of the U.S. dollar. So the dollar going down has been supportive for gold. And finally, cryptocurrencies have continued to rally on expectations of increased mainstream adoption. That's not just individuals, that's also corporations. And we are seeing more regulatory legislation working its way forward in the United States. And as I mentioned a bit earlier, the one thing that's a bit troubling is there's a big disconnect between earnings results and the market reaction. The U.S. economy has been strong, and we're seeing that in earnings. And the majority of companies have not just beat street expectations, but beaten by quite a bit. And they've been beating on sales. And guidance has generally been positive. And some companies that suspended guidance have actually resumed guidance. So everything has seemed to be generally positive. Yet we're seeing consistently across a number of countries and companies across a number of sectors this 5% hit, 5% hit, 8% hit, 10% hit, 5% hit, across a number, or nothing, or limited 1 to 2% declines. But we're not seeing many rallies. We're seeing more pullbacks in the market, and it seems to me that it's because, as I showed on the seasonality slide, May and June were much stronger than usual, and it looks like strong results have already been priced into the market. And as such, we're actually, if anything, seem to be seeing traders start to take profits following these rallies against the earnings numbers. And we'll see if that continues to play out, but most of the major North American companies are reporting results over the next 2 to 3 weeks as the heart and the bulk of earnings season, and then the 3 weeks after that through to the end of August is pretty much everybody else. And by the time we reach the end of August, early September, Labor Day, the earnings season pretty much done. So looking at how the U.S. has done relative to the rest of the world, it's really interesting when we look at this chart because we can almost break it by that sell-off rebound in April. Prior to April, the U.S. dollar was generally outperforming other markets around the world. The TSX was fairly close, but overseas markets were lagging. Then since April, we've seen the TSX outperform, the U.S. lagging, and overseas markets in the middle stronger than the United States. And what's most interesting about this also is the U.S. equity returns by the falling dollar. Is the U.S. markets had a big rally over the last 3 months, but this is at a time when the U.S. dollar has been going down. So the U.S. index is priced in U.S. dollar terms, but when we look at it in other countries, the U.S. was lagging Canada, which is the orange line, up until the end of June. And it's only here in July that the U.S. dollar, the U.S. equity market has turned positive year to date in Canadian dollar terms. And in euro terms, it's still negative. The euro has actually still is out. The euro against the US dollar is outperforming the US equity market versus the US dollar. Looking at the relative performance of sectors, I noted gold has held up. Gold stocks have also held up. They had a big rally in the first part of this year. Since the beginning of June, gold stocks have been sideways, consolidating gains. What have we seen strength in lately? Strength in cyclical, strength in industrial, strength in tech, pulling up the overall market. We are seeing weakness in defensives. This green line is healthcare, and we can see that's been in steady decline since the beginning of March. Looking also here at, I mentioned cryptocurrencies. In this chart, I like to look at gold versus Bitcoin and also versus the U.S. equity market. And again, the U.S. equity market, even with the rally of the last few months, continues to lag behind the gains of gold, and Bitcoin has just been explosive since April. First of which was the improved confidence, reduced fear, and then this latest run-up has been on anticipation of cryptocurrency regulation and mainstream adoption. The relative performance of the US dollar is the black line. It's been steadily declining, and as that's declined, we've seen metals rally. So we saw gold as the orange line had led the rally for most of this year, and now it's leveled off. But what we have seen of late is other things starting to climb. Silver is green, it's been rallying. Copper is the maroon colored line, that's been rallying, and the most explosive of all is the blue line, that's platinum. Platinum has been exploding upwards. So what we're seeing is that other precious metals and even base metals are playing catch up to this big rally that gold has had. Moving now to a look at some markets, we're seeing the NASDAQ has been very strong and remains strong. We're not seeing any kind of a correction in the NASDAQ at this point in time. It's broken out to new all-time highs. The Russell 2000, the small caps, are strengthening, but they're also lagging. They're not at new highs. They're still lower compared to the other markets. The big cap markets are still leading the way. The NASDAQ, the S&P, TSX in Canada also rallying to new all-time highs. It's been very strong. And the MSCI World ex-US, this is overseas markets, again, broken out to new all-time highs, continuing to rally, not even a three-box reversal in any of these major markets. Equities remain very strong moving through July, even though we have had selective corrections as companies have put out earnings. Gold, as I mentioned, had a big rally earlier in this year. It really started in early 2024, rallied for a year, and now it's paused. But it has paused, it hasn't pulled back. US dollar CAD ran up into resistance earlier this year, and it had started to roll back down a little bit. Dr. Copper, which is running as well, and we can see it has broken out and continued to climb. Crude oil is one market that has struggled quite a bit. Crude is definitely having a tough time. It did have a bit of a rally in June with the war in the Middle East, but even then, it never broke out of this downtrend. It remained it only got up into the low 70s. So there's still some concerns out there about the sluggishness in the energy market. And now I will speak briefly to our portfolios. Our SIA Wealth Management continues to navigate through volatile markets using our relative strength-driven, rules-based investment strategies. As I mentioned, the equity action call is in the green favored zone, and equity exposure is at 100%. We had mixed performance in the second quarter relative to benchmarks, although all portfolios in Q2 did generate positive returns. There's a reason for this. First of all, we saw that the Tactical Global Asset Allocation ETF Fund, the BMO SIA focused Canadian Equity Fund outperformed their benchmarks. The BMO Tactical Global Equity ETF Fund and the BMO SIA focused North American Equity Fund underperformed their benchmarks in Q2. So it was mixed. Two beat and two were short. But what we saw primarily was portfolios maintained higher cash levels through the high market volatility through the first half of the quarter. They didn't return to 100% equity until the middle of May. Since the middle of May, performance has improved. Also, we did maintain as a relatively higher weight in defensive sectors and gold equities during the quarter, although there was also some rotation back into cyclical sectors. The other thing we did during the quarter was we increased international equity exposure. For the first time in ZFN and ZFC, the Canadian, the BMO SIA Canadian and the BMO SIA focused North American equity funds introduced a 10% equity sleeve. Also in the ETF funds, the BMO Tactical Global Asset Allocation, BMO Tactical Global Equity ETF funds, we rotated the broad-based ETF exposure away from U.S. equity to international and Canadian equity in response to changes in the asset class rankings. So looking at our exposure in our portfolios at July 21st, we can see where we were at peak cash in April and May. We had raised some significant cash positions. Current cash is around 1%. In the asset allocation fund, the fixed income is about 42%. This is common. We still have gold exposure to the tune of 5% in the ETF funds and 11 to 18% in the two equity funds. In terms of defensives, we can see in the Tactical Global Equity ETF Fund, 39% defensives, 55% cyclicals. In the Global Asset Allocation Fund, about 18% defensives, about higher in the cyclicals. We're running about 12% in the BMO SIA Canadian and North American equity funds and 70 to 75% cyclicals in those funds. In terms of how we're split geographically, the Canadian equity fund, we note the introduction of the 10% international equity sleeve. Same with the BMO SIA focused North American equity fund. Again, we have a 10% international sleeve, 35% Canadian equities, 54% U.S. equities. We're somewhat more balanced in the ETF funds. In the Global Equity ETF Fund, 36% U.S., 18% Canada, about 45% international. And so again, we do have more international than we've seen in quite some time. And in the Asset Allocation ETF Fund, 20% U.S. equities, 25% international equities, and about 11% Canadian equities. So looking ahead into the rest of the summer, the political environment generally seems to be improving. Trump more or less has been getting his way. The U.S. economy has been resilient, but there's still risks around tariff negotiations. There's still risks that somebody might miscalculate and things could go off the rails. We are moving into what's historically been the seasonally weaker and more volatile time of the year. It tends to particularly run between about mid-August and mid-October. Our relative strength indicators, though, have strengthened significantly, remain strong. The overall environment for equities remains positive, but we do continue to monitor trends in capital flows and relative strength. And as always, we're prepared to make tactical changes as necessary, whether that's between sectors, whether that's between investments, whether that's between asset classes. And we'll wrap up here with our disclaimer slide. We'd like to thank you all very much for joining us this month, and we look forward to catching up with you again in a month from now.